How to identify the best tech companies and indexes. Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome back to Rhino Invest, the financial library for young professionals. Technology stocks offer investors a lot of interesting opportunities, but things can change fast in tech, so you need to know exactly what you're looking for. Today, I'll take you through how to identify the best tech companies and indexes. I'll also tell you how to read an S1. If you don't know what that is yet, be sure to stay tuned. Before we dive in, if you want to get a handle on your personal finances, open an account with Rhino Invest today. By opening a Club Rhino Plus account, you will have access to a wealth of resources for financial success. From a net worth tracker to checklists, handouts, our reading list, courses, an educational portal, and a forum to speak with other rhinos. Go down to the description of this video and click on the Open an Account link. Subscribe to this channel to see more of our content and click the bell icon to receive a notification when a new video is published. All right. Over the last decade, the technology sector experienced exponential growth and outperformed the overall stock market thanks to a low interest rate environment and some of the bigger tech stocks like Apple and Meta, Facebook's parent company. With higher than expected inflation and interest rate hikes, the good fortune of the tech sector has reversed recently. But no one ever got rich buying high and selling low. So if you're bullish on the tech sector, it might be the right time to buy the dip. The tech sector is vast. It covers everything from software developers to streaming services to semiconductor companies to artificial intelligence to cloud computing and more. One-time leaders can quickly fall behind, getting caught up by innovative startups. By being a great investor, you have to research. You should always be learning, tracking, and staying engaged to build your investment knowledge. Follow news and updates about companies you're interested in. If you want to learn more about how to be a successful investor, click the link you see on your screen right now. For tech companies that have been around for a while and produce profits, a useful metric is the price to earnings ratio. To calculate this, divide the stock price by the per share earnings. This tells you how likely the market is valuing or how highly the market is valuing a company's future earnings. The higher the ratio, the more the market is valuing future earnings growth. For a tech company that isn't profitable, price earnings won't help you evaluate them. Often these companies are younger and revenue growth will matter more. You want to make sure an unproven company has strong prospects for growth. You'll also want to see a bottom line that is moving towards profit. A growing company should be becoming more efficient. If it isn't, that could indicate something is wrong. Ultimately, you're looking for a tech stock that is being reasonably valued given its growth prospects. What if a company is just now going public? This is where the S1 comes in. Form S1 is a document that companies must file with the Securities and Exchange Commission before going public. That is, listing their shares on a stock exchange in the United States. The form includes information about a company's history, managers, finances, potential risk, and more. If you're interested in investing in a company during its initial public offering or IPO, this is the form you want to understand. So, how do you read an S1? The first and most detailed part of an S1 is the prospectus. This is where you'll find all the key information about a company's business, finances, and the offering. The second part of an S1 is optional, with some of the nitty-gritty details like when a company's fiscal year will begin. Now I'll take you through some of the key sections you'll want to focus on in the prospectus, which you can use to decide whether the tech company you're interested in is a good investment. In the summary, you'll learn all about what a company does, including what its customer base is, when it was founded and where it operates, how it makes money, and what market opportunities its leaders see. The risk factor section will lay out all the risks that the company and industry could face. This can include anything from competing products to regulation to negative publicity. To make an informed investment decision, you'll definitely want to be aware of all the potential risks. The management discussion and analysis section will take you through what factors a company's leaders think are significant, such as sources of revenues and strategies. The management section also gives you background on the company's executives and board of directors, including roles, ages, and career histories. These bios are meant to make leadership look good, so do some outside research as well. This will also include information on how exactly top management will be paid, including base salary, stock, and bonus targets. Companies are also required to submit independently audited financial statements. As you dig into those financial details, be sure to pay close attention to revenues, costs and expenses, net income or profit, and how the company is capitalized. The S1 also includes information on who owns shares in the company and what types of shares before it goes public. The company will also estimate how much they will net from their IPO and how they plan to use the money they raise. In the dividend policy section, you can learn whether the company has ever paid dividends to shareholders and whether it plans to in the future. Last up, be sure to check out the related party transactions section, where the company discloses any financial deals or relationships involving more than $120,000 between the company and a related party, such as any of the company's directors or officers, shareholders owning more than 5% of the company, or an immediate family member of any of those people. If that all sounds like biting off more than you wanted to chew, I hear you. While you're bullish on the tech sector, you are less certain you know which companies to invest in. A tech index fund or an exchange-traded fund, also called an ETF, can mitigate the risks of investing in individual companies. ETFs are marketable securities that track an index, a commodity, bond, or a collection of assets. If you want to learn the difference between mutual funds, index funds, and ETFs, click the link you see on your screen now. With a tech index fund or ETF, you can target an area of the market without having to choose the specific stocks to buy. Again, the key to good investing is to do your research. But now with an overall sector in mind rather than a specific company, some tech index funds and ETFs will track the technology sector overall. And because of the size of the tech companies like Apple and Meta, a broad index fund or ETF that tracks the overall stock market, like the S&P 500 index, also comes with a lot of tech sector exposure. Maybe there is a niche of the tech sector that you're especially bullish on. Then you can find an index fund or ETF that will focus on that specific niche, whether it's artificial intelligence or fintech. Keep in mind that different areas of the market will come with different levels of risk. The broader an index fund or ETF, the more stable it usually is. Technology index funds and ETFs can be an excellent option for gaining exposure to the tech sector while mitigating risk, particularly if you're new to the tech sector or you're more devoted to prospects of the overall market rather than a specific company. By doing your research and keeping in mind both the potential risks and returns, you'll be able to make smart investment decisions, including which tech companies or indexes you want to invest in. Subscribe to this channel to see more of our content and click the bell icon to receive a notification when a new video is published. Thanks for watching, and until next time, this is Cashin reminding you to seek real education, invest in performing assets, get rid of bad debt, and engage in oversight of those assets.